Podcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Welcome to SECAF's webinar entitled Recent Legislative and Regulatory Developments Affecting Small Business. If you guys recognize my voice, my name is Kurt Anderson. I am the chairman of the board of directors, and I'm also vice president of corporate growth at a small business called Strategic Resolution Experts, a management consulting and IT services management company. For those of you on our call who may not know, SECAF is an association with a mission to serve government contractors. Our objectives are to educate, empower, and enable growth for the government contractors. We bring key government and industry leaders to interact with our member companies to help them navigate the world of government contracting. Today, SECAF is extremely excited to launch this new webinar series, SECAF GovCon Institute. The series will include a set of 6 fundamental educational how-to webinars and 2 to 3 current issue webinars that might include, for example, legislative and regulatory updates, or information about upcoming GovCon growth contracts, or even best practices during a government shutdown. We really welcome your feedback, your input for future topics, because it really helps us to be successful. Part of this webinar is we will post a post-webinar survey for you to make the suggestions accordingly. Today's webinar is being hosted by Uninet. Uninet is a committed partner in so many ways to SECAF. The webinar will be presented by Devin Hewitt of Praetori Law, also an incredibly valuable partner to SECAF and a member of our board. I would also like to introduce Rich Wilkinson, who is the Director of Solutions Engineering at Uninet. Over to you, Rich.
Thank you, Kurt. Some of you know me or at least recognize the name. For some of you, I'm a complete stranger. I've been kicking around the GovCon world for about 40 years now. I spent 8 years as a Navy contracting officer and 10 years working my way through local government contractors as a controller. And I've spent the last 20 years in the government contract accounting software business, a highly specialized sector of the software industry. Today's presentation is brought to you in addition to the SECAF sponsorship by Uninet. We provide accounting software for small and mid-sized government contractors. So let's get started. Before we launch into the presentation, just a few housekeeping items. Each of you should have a small control panel in the upper right-hand corner of your screen. You can minimize that to just a little bar. All the participants are muted, but you can ask a question at any time by maximizing that little bar and typing it into the questions box. If we have time at the end, we'll answer as many of those questions as we can. If not, we'll review the questions and respond to you after the webinar. Below the questions box, you'll see a handout. We've provided today's presentation as a handout so that you can print it if you like and follow along or make notes. Last but not least, every attendee of today's webinar will get a copy of the webinar presentation and a copy of the recording. It's my pleasure at this point to introduce Devin Hewitt, who's a board member of SECAF and the chair of its Legislative and Regulatory Committee. Devin is also a partner at Praetori Law. Devin, thank you for joining us today.
I'm happy to be here. Poll questions.
Number 1, is your business a small business, perhaps an 8A, a hub zone or a woman-owned business, a small disadvantaged veteran-owned small business, or not a small business at all, a large business, or some other classification of service provider? We'll give you a couple minutes to answer that poll, actually a minute or less. Don't want to eat into the presentation time. Jess, as soon as the poll is complete, just let us know what the results are.
All right, Rich. It's a pretty big spread. We have 36% are small businesses, 7% are 8A small businesses, 21% are hub zone or women-owned small business, 25% are small disadvantaged veteran-owned small businesses, and 11% are not a small business. So it kind of runs a gamut.
Wow.
Mm-hmm.
How many service providers?
I'm not sure.
Well, I just want to say that this is copyrighted for that.
We have a second poll, and then we'll get into the presentation itself. If you would please classify yourself by size, up to 7.5 million, or from 7.5 to 15, 15 to 27.5, more than 27.5 up to 50 million, or larger than that, a large business. Jess, what's it look like?
Well, interesting spread again. We have 35% are 0 to 7.5 million in revenue. 25% are 7.5 million to 15 million. 20% are 15 to 27.5 million. 11% are more than 27.5 million, and then 8% said none of the above, a large business.
Okay. The agenda today, we'll start with legislation, and we'll start with the Small Business Runway Extension Act of 2018, and then we'll go on to the consolidation of VA and SBA eligibility rules. Devin, take it away.
Thank you. I'm happy to be back here. I've got version 2.0 on this presentation, which means that I fixed the bugs of the first presentation, and hopefully that includes our technical difficulties, and added some new and exciting enhancements. As Rich mentioned in the agenda, we really have three sets of topics we're going to address. The first is the only legislation that's been a major advancement in small business government contracting, which is the Small Business Runway Extension Act of 2018. The only final regulation had to do with VA and SDVOSBs. And then the remainder and primary portion of this presentation is going to address three separate proposed rules, some of which are quite substantive. There is a large rewrite of the HUB-Zone program, and there is a large cats and dogs regulation that sort of was disgorged by SBA early December, which includes a number of items, again, that are somewhat complicated and will affect small businesses, certainly as respect to certain regulations on limitations of subcontracting, which was a big agenda item for SBA earlier in the year. Most small businesses are familiar now with the Small Business Runway Extension Act. It was signed into law in December 17th, and it changes the period of measurement for size calculation purposes from a 3-year fiscal look back from date of proposal submission to a 5-year look back of fiscal years. Most small businesses are very excited about this legislation because it gives them more time to gain the benefits of being a small business. But remember, it cuts both ways. If it turns out that you've had increased revenues in the latter part of the 5 years, that might be okay because you're going to have the decreased revenues in the first part of the 5 years to take into account. But if you had a large amount of revenues in the first part of the 5 years and then decreased, obviously the high level of revenues will still be counted. So it does cut both ways. What is interesting and most controversial about this legislation is that SBA has taken the position that it does not go into effect until they propose implementing regulations. And the typical process for finalizing regulations is for an agency to issue proposed regulations, receive comments on those proposed regulations, and then issue final regulations. And this process often takes longer than a year. And that time frame, a year, can make a big difference to a lot of small businesses when you're comparing 3-year look back to 5-year look back. It's controversial in part because there is a case that says that if legislation is passed and signed into law, it is effective unless the legislation itself says otherwise. And this legislation does not say that. I think it's because SBA actually, unbeknownst to a lot of people, was not supporting this regulation. They thought it would work to the disadvantage of smaller companies and allow larger small businesses to stay small longer. So they seem to be a little recalcitrant in implementing or recognizing the effectiveness of this regulation. I suspect that this will be subject to some sort of lawsuit because it will make a difference to many small businesses, and most of them will push and choose 5 years if it's more advantageous, and then wait for SBA to object, and then there will be litigation finalizing the interpretation of the look-back period. The second final rule has to do with the consolidation of SD-VOSB, VOSB eligibility rules regarding the VA's SD-VOSB, VOSB Veterans First contracting preferences and SBA's SD-VOSB program. These two programs were implemented under two different statutory authorities. So the eligibility and the ownership requirements for SD-VOSBs was different under the VA program than it was under SBA's program. And although the VA program regulations were modeled on the SBA regulations, and in fact, I was at the table present with Tom Laney when we started to draft these regulations, over time they have been interpreted a bit differently. And this obviously has created inconsistencies when there is an SD-VOSB that wants to compete for a VA program, but also wants to compete for an SBA program. So finally, the bright minds in the government decided that they would consolidate the eligibility, ownership requirements, and so now they are consistent, although they are not as expansive as they were under the VA program. So there's a little bit of pulling back to mirror the SBA rules. VA, however, will have the exclusive jurisdiction to verify SD-VOSBs and VOSB status and include those companies in the CVE or database, the Vets First database. Protest of status will now be reviewed by SBA, decided by SBA, and reviewed by SBA's Office of Hearings and Appeals. What most people don't know is that there was one regulation or one provision that was inserted in this final rule that I believe is a significant difference. Specifically, one of the issues has been with any particular small business, the ownership and control requirements where there is a minority investor or a minority owner. Typically, we classify those minority owners as passive investors because under the rules for these small businesses, there is a control requirement, which means that the minority investor cannot participate or otherwise issue or participate in decisions that guide the company. What typically has been done by lawyers and other individuals who create an operating agreement is to allow some participation in some limited decisions of the primary or the majority holder of these companies. And the VA actually was more permissive in this regard, and actually it went into federal court where things like follow-on rules, tag-along rules, the court decided were not control issues, even though they benefited the minority investor. And as a result, they said that those sort of provisions were fine. SBA has never taken that view, and they have been far more restrictive. So in terms of consolidating these rules, SBA included this provision, which is not included in their current rules and was not included in the VA rules, which talks about the circumstances under which a minority investor or a minority owner could participate in important decisions made by the company, by the majority owner. And the provision in the rule is called extraordinary circumstances. And the definition of extraordinary circumstances is adding a new equity stakeholder, dissolution of the company, sale of the company, merger of the company, and the company declaring bankruptcy. These are the only circumstances in which a minority investor or owner of one of these small businesses will have veto power. And so it lays it out. Like I said, this was not necessarily the case under VA. They allowed tag-along, drag-along rules, which are very common in corporate acquisitions, mergers and acquisitions. And it is a little bit more forgiving than SBA's existing rules, although there wasn't any actual law that addressed it. This is a little problematic because they, as always, they sort of forget the obvious. What they don't say here is that there should be a veto power by the minority owner to any changes to the operating agreement. Because obviously this is all for naught if the owner can now change the operating agreement to eliminate this provision. And in most cases, these operating agreements, when they were done previously, said that the majority owner had the full control over the operating agreement. But given these permissive participation requirements for minority owners, one should also assume that a minority owner has veto power over amending the actual operating agreement. A bill was also introduced not too long ago, which proposed consolidating VA's verification responsibilities with SBA's government-wide verification program for veteran-owned small businesses. This means taking the entire Veterans First program and transferring it to SBA. It's not seamless because there are two statutory authorizations, and there actually has been a lot of objection for SBA because they don't want to keep taking on responsibilities for which Congress doesn't seem to want to fund. One of the most major developments last fall was a proposed rewrite and revamping of the HUBZone program. The HUBZone program was established in 1997, and it has not been reviewed or revisited or rewritten since that time. So almost 20 years have gone by, and obviously things change, and courts or OHA interpret the regulations differently, and there's been inconsistencies and also some difficulties with getting this program off the ground. Some of the inconsistencies and dual interpretations of the regulations have not provided the certainty that most businesses require when they make some investments in any type of business, let alone a business here that requires a certain geographical location. So the first thing this new proposed regulation wants to address is the issue of HUBZone mapping and redesignation. Typically, this is done after a census, and the problem is then when there is a redesignation and the two issues which are key to eligibility of HUB zones, the employee residency requirement and the principal place of business requirement could obviously be non-compliant if there's a redesignation of the HUB zone. So this proposed regulation states that they will freeze the current HUB zone maps, which were redesignated in 2017, until the next census, 2020. And so until December 31st, 2021, there will not be any redesignation. So in the short term, there will be certainty that where employees reside and where the principal office is located will remain the same. Later, we'll talk about employees moving out of HUB zones and what this proposed regulation suggests that should apply to that situation, which has also been a problem. But with regard to redesignation of the geographical area, it will be frozen till 2021. They will redesignate every 5 years, three afterwards, after that. And then you'll have the 3 years grandfathering period. So again, this is intended to address the uncertainty that is created by constantly redesignating the geographical areas of HUB zones. Another huge change that is proposed by this regulation is the timing of HUB zone certification. Currently, after the HUB zone is certified, it has to recertify or re-represent its compliance and HUB zone eligibility at the time of its offer and the time of award. And that again proved a little bit uncertain because procurements nowadays can take a very long time. So notwithstanding all the effort and bid and proposal resources that are expended by a HUB zone, they may not be able to realize that if the award is substantially many years afterwards and things have changed. And also the current rule is certification every 3 years. What the proposal now is that certification will be, or recertification will be every year on an annual basis. And upon first blush, that sounds a bit more restrictive than the 3-year period. But on the other hand, they've now eliminated the certification or representation requirements that previously existed for bid and proposal timing and for award timing. And so they feel that this, the regulators feel that this allows more certainty with respect to contract performance and contract bidding. Now, the HUB zones would still have to certify when they submit their proposal, and actually all businesses, all small businesses typically do, because they have to indicate that they've registered in SAM, and then SAM is annually needs to be updated. But when they certify and submitting the proposal, that certification will go back to the annual certification date. Now, the two other changes that I'd like to focus on in this proposed rule has to do with the two key discriminators of HUB zone eligibility. The first is the 35% employee residency requirements. And that really has two criteria. The first is what is the definition of employee, and then what is the definition of reside. So there are a number of different proposed rules in this proposed set of revisiting the HUB zone program, but I'm going to focus on those two at least first. With respect to who qualifies as a HUB zone employee, the proposed rule clarifies that an employee is anyone that works more than 40 hours in the 4 weeks that precede the date of certification or recertification. Now, interestingly, in this proposed rule, SBA has announced that they are considering actually changing that benchmark and reducing it to 20 hours per week, because they've received complaints that 40 hours per a 4-week period is really not enough to stimulate employment and economic development in these HUD zone areas. So that is essentially would be doubling the 40 months. And so they're seeking comments on that, and I suspect they will run, both pro and con. The biggest change here with respect to employees and the residency requirements is that if an employee resided within a HUB zone at the time of certification or recertification, if the employee has moved out of the HUB zone but still works for the HUB zone, that employee will still be considered an employee who resides within a HUB zone. Or if the employee resided in a HUB zone at the time of a HUB zone certification or recertification, but then there is a redesignation and that employee no longer resides in the new HUB zone geographical area, that employee will still be considered to be a HUB zone employee. So again, this addresses a lot of the vagaries of employees moving in and out of geographical regions. SBA has stated that it doesn't want to penalize employees that started or lived in a HUB zone but then improved their circumstances and moved out of a HUB zone. So this is the reason for this particular revamping, and I think it's going to be welcomed by most HUB zones. The same thing is for the case for employees that work overseas. There was in the current regulation a reference to primary residence and then presumably a secondary reference. And then with respect to the residence that was the primary residence, you had to demonstrate an intent to stay in the area, which obviously is a general statement and hard to prove. This proposed regulation eliminates all that. Instead, there is a requirement that the employee lives in the HUB zone, I'm looking here, about 180 days prior to the certification. So that, that's a sort of black and white rule that allows employers and, and regulators and those who review compliance issues to be able to rely on something certain. With regard to the owner of a HUB zone, there has been complaints that HUB zone owners who do not reside in a HUB zone have not been considered employees. And now the proposed rule says that if you are an owner and work at least 40 hours, compensated or uncompensated, in that 4-week period, you will be considered an employee. And you will still be considered an employee if you work less than 40 hours, if there has not been a hire of a supervisor who may have assumed some of those hours. So that will now be included in the calculation. There are different rules now for independent contractors, and you'll see this theme throughout these proposed rules. Simply put, with respect to the HUB zone program, an independent contractor will be considered an employee if that independent contractor is considered an employee for purposes of determining the size of a company that is under a NAICS code that has an employee size standard, and that's mainly manufacturing companies. And finally, there is an issue with regard to affiliates. HUB zones can have affiliates, but the employees of affiliates will now be aggregated with the employees of the HUB zone unless there is a quote-unquote clear fracture between the two companies. And the term clear fracture should be familiar, because that is also the term that's used in other affiliation principles, particularly with regard to a company that is formed in the same industry or by affiliated people from a prior company. So that concept of clear fracture is now being applied to HUB zone affiliates and their employees. With respect to the term reside or residency generally, as I mentioned, as long as the employee lives full-time for at least 180 days, immediately prior to certification, if they live in the hub zone area, they will be considered to have resided in that area. They have eliminated the requirement to demonstrate a principal or primary residence and eliminated the requirement to demonstrate the intention of that employee to remain in the hub zone, quote unquote, indefinitely. There is a whole new regulation now with respect to attempt to maintain. Obviously, a 35% residency requirement is hard to maintain for a long period of time. And so the regulation that exists now requires hub zones to attempt to maintain that 35% by demonstrating efforts they've had to recruit and hire individuals who are residing in the hub zone to bring it up to the 35%. However, that attempt to maintain benchmark has been a little bit hard to interpret and also can be very general and inconsistent in its interpretation. So now the proposed rule says that if the employee residency requirement drops to a number below 20%, there will be a presumption that the hub zone has not really made an attempt to maintain the 35% residency requirement. However, the rule does explicitly state that this 20% only needs to be achieved over the term of a contract, during contract performance. And they're not going to pick a particular time to measure that 20%. So, for example, if a hub zone has submitted a bid, wins a contract that requires that hub zone to staff up, and during that process, the first few individuals they hire are not individuals that reside in the hub zone, that will not mean they're automatically thrown out, because at that period in time, they are dipping below 20%. The goal is that the 20% or above threshold is met during contract performance and after sort of the ramp up has been completed. There's also a clarification in this regulation about which employees are considered or included in the calculation for the two different aspects of eligibility. One has to do with the 35% residency requirement, and one has to do when you are determining the principal office. The residency requirement calculation counts all employees, no matter where they live, whether they live in a hub zone or not in a hub zone, and regardless of where they work. However, in terms of compliance with the principal office requirement, they also count all employees except those employees that work on site. So there is a distinction when you are counting employees with respect to whether the calculation is for principal office or whether it is for the 35% threshold. Now, SBA, again, is requesting comments on this interpretation, and you'll see that throughout this proposed regulation. There are a number of instances in which SBA explicitly asks for comments from industry. The second proposed rule is one that, to use a legal term, is laughable. On May 31st, 2016, SBA issued a final rule that implemented changes authorized by the 2013 National Defense Authorization Act regarding limitations on subcontracting. Before that time, there was an SBA rule regarding limitations on subcontracting and a FAR clause regarding limitations on subcontracting. The FAR clause, of course, was included in contracts, and the SBA rule was included in the SBA Code of Federal Regulations. Contracting officers tended to follow the FAR clause in the contract, no surprise, and SBA followed its regulation in determining size or status protests. However, SBA, with all good intentions actually, revised their regulation on limitations on subcontracting. And what they changed was the existing calculation, which referenced cost of contract performance incurred for labor, to now a more black and white and easy amount to reference, and that is amount paid. So the SBA rule currently says that a small business prime contractor has to receive at least 50% of the amounts paid by the government for that particular contract. Well, that's terrific for small businesses. However, the FAR rule never caught up. So now we're in a situation in which there's a FAR clause that includes the old calculation based on costs incurred for performance for labor, and an SBA rule that depends on payments. Now, DOD was quick to remedy that issue, and on December 3rd issued a FAR deviation, which made the FAR rule, the DFARS rule, consistent with the SBA rule. The FAR Council, in its infinite wisdom, however, on December 4th, decided it would issue a proposed rule, making the two rules consistent, which means that it is still not effective and may not be effective for another year. They're asking for comments, and if anybody submits comments on this, they really don't have enough to do, because this is absolutely not controversial and something that needs to be addressed, because businesses don't know which rule to comply with. And contracting officers have been, are really torn between the two, because it's understandable that a small business doesn't want to be exposed to a protest, but they typically follow the FAR. And so this has really created a lot of problems, and it's just odd, to say the least, in a diplomatic way, that SBA and the FAR Council can't come to terms on this and remedy this right away. Perhaps the most under the radar and most significant proposed rule that was issued by SBA last year was a proposed rule that included a number of miscellaneous items. It was proposed on December 4th, and it included, I don't know, maybe 10 or 11 items that really had no relationship to each other, and addressed various issues, and some of which could be significant for a particular small business, depending on the nature of what it provides or its size, etc. I summarize very briefly each of these issues that were addressed, but I'm going to focus first, at least, on two issues that are complicated and that I think it's important for small businesses to be aware of before sort of getting into the very specific rules that only affect a certain percentage of small businesses. The first of these has to do with limitations on subcontracting. Again, this has been a very controversial area for interpretation and application of the rule. One of the major changes that SBA made to the limitations of subcontracting regulation that they have occurred several years ago, and introduced this concept of similarly situated entity. So for large, complicated, small business set-aside contracts, it was sometimes difficult for one prime small business to do 50% of the work and still comply with the requirements. So what SBA now did was to allow a small business to combine the resources of other small businesses to perform the primary work and be included in that 50% calculation. The only specific requirement was that those other businesses had to be similarly situated. And what that meant was, if the prime contractor was submitting a bid that was set aside for service-disabled, veteran-owned small businesses, the prime contractor small business had to be a service-disabled, veteran-owned small businesses. And that SDVOSB could use the resources of other small businesses as long as they were also small, disadvantaged, veteran-owned small businesses. So they were similarly situated. Now, the issue about that became a other things, like when there was a similar situated entity that was also subcontracting to a small business and unduly relying on that small business to do the work, or otherwise letting that small business do the principal functions of the prime contract. This is called ostensible subcontractor affiliation, and it's generally applied when you have a small business prime and a large business sub, and there is a set aside for a small business. It's common and very well known that if that large business is really doing the work and directing the contract, that the prime, small, and the large sub will be considered joint venture partners and therefore affiliated, and the size will be aggregated. That is, unless they are participating in a mentor-protege program. This concept created difficulties, however, when you had a particular type of small business that was a prime, like a service-disabled veteran small business, that actually unduly relied on a small business, or the small business subcontractor was doing the principal purpose of the prime contract. If you followed the ostensible subcontractor affiliation rule, that would mean that the small business sub would be a joint venture partner to the SDVOSB prime. They would end up being affiliated, and then their size would be aggregated. However, there is another exception to the affiliation rule. The most well-known exception is a mentor-protege relationship, but there's also an exception when there are two or more small businesses that are members of the joint venture. So if all members of the joint venture are small, they will not be considered affiliated. So when you have this similarly situated situation that is violated, where there is a prime that's an SDVOSB, a small business, and the small business is doing all the work and therefore is an ostensible subcontractor, they won't be affiliated under the current joint venture regulations. Well, this obviously created a lot of consternation, because the whole point of doing an SDVOSB set-aside is to make sure that the contract revenues go to an SDVOSB, not to a small business. So as a result, they haven't changed the joint venture regulations, but what SBA has now said is that we will consider that ostensible subcontractor allegation in a size protest. So you can make a protest saying that a SDVOSB and a small business sub are affiliated under the ostensible subcontractor rule, and therefore not large if the affiliation results in revenues that exceed the size standard applicable to the procurement. So that is, a big step forward, and actually a very complicated one if you put it side by side with the similarly situated rule and side by side with the joint venture exemption rule. Another proposed rule associated with limitations on subcontracting is what costs are included. Under certain contracts like construction, material costs are excluded in the calculation for the 50%, or in construction contracts, 15%. That concept has now been introduced with respect to services contracts, primarily because industry has complained and educated SBA that there are some ODCs that are necessary in certain contracts that otherwise, if exempted, would make a company small, but if included, would make a company large. And the example that SBA uses in the regulations had to do with environmental remediation. The transportation and disposal of environmental toxic waste, et cetera, is highly regulated, and only large companies generally have the certifications and the like to be able to actually dispose or transport that. And so SBA has agreed that that cost, that other direct cost, would be eliminated from the paid calculation of 50%. Same thing with media placement costs and airline tickets, hotel, but not travel yet. General travel, SBA says, is susceptible to abuse, so they are seeking comments from industry about how they should address that. There's also some controversy around cloud computing. It sometimes can be considered a service, sometimes a partial manufacturing or product, supply product. And so the cost of that has been debatable whether it should be included as part of a services limitations on subcontracting analysis. So SBA has asked for comments on that. The other rule or theme that is in this proposed rule, and that you'll see I referenced in the earlier rules, have to do with independent contractors and how they are treated. In the size determination rules, where there is an employee receipt standard, an independent contractor can be considered an employee if that independent contractor is considered an employee under IRS regulations, which have been interpreted by SBA in a policy statement called Policy Statement Number 1. And this policy statement number 1 may result in an independent contractor becoming an employee, but not necessarily. If the individual in question, the 1099, meets one of the requirements, they're typically considered an employee. And as I noted earlier, in the HUBZone situation, the HUBZone proposed rules suggest that an employee, if a 1099 is an employee for purposes of size, then the 1099 should be an employee for purposes of the HUBZone program. Now, this has been a little bit different, however, when you are looking at services limitation on subcontracting compliance and under employee-based size standards. The issue is, do you include independent contractors, the amounts paid them, in the 50% or not? And the controversy came up when SBA implemented the term similarly situated entity, which they defined to exclude independent contractors. According to that regulation, independent contractors are subcontractors. Whereas, as I previously noted, they are employees typically, or can be employees under the size standard for employee receipt size standard determinations and employees for the HUBZone program. SBA in this rule, proposed rule, reiterates that there is a difference of calculating independent contractors as employees for services contracts than for HUBZone, which focuses on an actual individual, and the employee size standard calculation. With regard to services, SBA reiterates in this proposed rule that independent contractors are subcontractors. So amounts paid to them cannot be considered amounts paid to the prime contractor entity, unless, of course, that independent contractor is a similarly situated company, in which case then they can be included in the prime contract calculation for the limitations on subcontracting. So I'm sure this is absolutely clear to everybody listening to this webinar, but just follow the ball through all these regulations and you'll be all set. With respect to some of the other, individual items that are addressed in this proposed regulation, the next most interesting, I think, has to do with task order set-asides. There's always been a question of abuse when a IDIQ is set aside for small businesses and then a contracting officer decides to compete task orders on, I'm talking about a multiple award IDIQ, of course, and the contracting officer decides to compete task orders on a certain stripe of small businesses. So they compete among SDVOSBs or HUBZones or WOSBs, And the result of which, if this is done consistently, is that the small business itself, or a small business who doesn't have those other designations, doesn't really get any work. And so that has been a complaint by these small businesses, because the point is, if you are setting aside for small business, presumably you want small businesses to gain the benefits of that, and not just the smaller stripes of this type of small business. SBA in this proposed rule hasn't changed that rule, but is seeking comments from industry about whether this is indeed a problem. I think that they've heard from contracting officers that it's really not an issue, but I think SBA wants to explore whether it is, because it certainly is, the way it's structured now, subject to abuse. The other new issue is recertification. Certification has always been an issue, because obviously certification and recertification has to do with your ability and eligibility for a certain contract, and particularly with respect to size. The new rule proposes that a small business must recertify its status also in full and open competition. And the reason for this is that agencies can take credit for contracts performed by small businesses, notwithstanding the fact that that contract was awarded pursuant to a full and open competition. But in order to legitimize the actions of agencies in doing this, they want the small business, or a certain type of small business, to recertify for that designation, to enable the agency to legitimately include that revenue in their and credit it against their subcontracting goals. And what this means for small businesses is that if you certify that you are a small business and you try to and you're going to comply with the limitations on subcontracting, but part of that has to do with using a similarly situated company to meet the limitations on subcontracting, if that similarly situated entity no longer is such during contract performance, then that revenue cannot count to the amounts paid. Now, this is obviously very clear as well, and I think will be very confusing to companies to the extent that they'd like to comply with this. Obviously, once it's issued in final form. Now, I think we want to leave time for questions. How much do we have left, Julia?
It's 10 of 1.
So 10 minutes?
7 minutes.
7 minutes. Well, you can now ask questions, but only if they're easy. And remember, you get what you pay for. Do we have any questions, Rich?
I am looking. Questions. There's a question about understanding of the expected hub zone proposed rule change timeline. What does the timeline look like for actual implementation of that proposed hub zone rule?
Well, my guess is it ain't anytime soon. This is incredibly complicated. They required or set the date for comments early February, then they extended it. I'm sure, well, I'm not sure, but I suspect that they will do another round of comments because it's so extensive and so complicated. And, you know, the presumption is that once they issue it in final, it might be another 20 years before they address it. So I do think it'll be quite some time.
Okay, there's another question about reliance on a sub. The questioner asks, if you have a large business subcontractor that offers to extend you a line of credit to meet purchasing requirements, would that be considered undue reliance on the large business?
That is an excellent question. And my answer to that is, it depends. That's the favorite lawyer answer. But I'll tell you why it depends. Because the SBA regulations regarding affiliation, they start right off the bat talking about how affiliation determinations is a determination that looks at the totality of circumstances. And so they look at all the ties and relationships between, in this case, a large sub and a small business prime. And then they determine whether or not there is undue reliance. So my answer is, if that's the only connection between the two, that may not be considered undue reliance. So I think it depends on the nature of the contract, maybe the line, how large the line of credit is, how difficult it would have been for the prime contractor to otherwise find that kind of access to capital, et cetera. So, again, it depends, and one could argue the facts in any way to show that indeed it's not an ostensible subcontractor situation.
Okay. This small business recertification, it occurs to one of our questioners that the timing could be very interesting. If it's pre-award, that's one thing, but what if it's post-award and the award bumps you out of the small business category?
Actually, that's not an issue. Remember that when you recertify for a full and open contract, the purpose of that obviously is not the eligibility to win the contract. The purpose of the recertification is to allow an agency legitimately to credit the revenue from that towards its small business goals. So if you grow out of your small business standard, that doesn't really affect your ability to perform the contract. And that's true pretty much for most contracts won by small businesses. They get to be small through the entire life of the contract, notwithstanding the fact that they grow out of a size standard. Well, that applies here. Of course, it applies in the full and open because there's no size standard. What the effect is that if you grow out of your size standard, the agency now cannot credit the revenue awarded your company towards their small business goals.
One of our questioners wants to know, what's the difference between a vendor and a subcontractor when performing a services contract that was awarded as a set-aside?
That's another excellent question. And indeed, I'm giving a webinar tomorrow talking about subcontractor flow-down clauses. And one of the issues we address in that particular webinar is what is a subcontractor? Because the FAR has a number of different definitions for subcontractor. And there's no law in terms of case law that has reconciled these inconsistencies. So my advice generally to clients is the distinction has to do with whether the company is performing part of the prime contract statement of work. That's a subcontractor. A vendor is a company that's providing a prime contractor with products or services that enable a company to do its work, including the work on the prime contract. So, for example, a company that provides, computers or information technology, help desk services, that company is not a subcontractor because they're just helping the company. However, if there is a scope of work in which the prime has to provide a help desk for a particular agency and therefore subcontracts that, or has another company do that work, then that work is a subcontract.
Okay, just a couple more. Do you have any insights, Devin, as to when we might start seeing some of these lawsuits you anticipate regarding the 3-year versus 5-year look back?
No. It'll happen once it makes a difference for a small business that can pay for the lawsuit.
So somebody has to have standing first.
Well, yes, they have to have standing in that they have to be affected by it, but not everybody that is affected by a rule can afford to litigate it. So once it's very important for a business, and maybe it's a live or die situation, and they otherwise not only need to, but can litigate, they will.
Probably our last question. This similarly situated situation with the limitation of subcontracting. Well, I have to confess, my head exploded about halfway through that. But can a company self-certify SD, VOSB status, for example, or does it require VA certification?
It depends on the agency issuing the procurement or running the procurement. The SDVOS program that's run by SBA is government-wide. It applies to all agencies, and they can set aside for SDVOSBs, and it's only an SDVOSB set-aside. VA is the only agency that can set aside contracts or must set aside contracts for SDVOSB or VOSBs first. They have the first right to do that. And in those cases, in order to be awarded a VA contract that has been set aside for SDVOSBs or VOSBs, they have to be included in the VA VETBIS database and certified as such by VA.
And I think that brings our presentation for today to a close. There are a couple unanswered questions. We'll circulate those and try to get those back to the questioners directly. I'd like to thank you, Devin, for speaking today. This has been tremendously informative. Unionet's proud to be a SECAF partner, and we are very thankful to SECAF for their participation today and their sponsorship. Thank you very much to the audience for joining us today. Later this afternoon, you will get an email asking for your feedback. Please take a few minutes to answer that brief survey. This email will always also include a link to a recording of today's webinar. For SECAF members, we'll post this webinar for your future reference on the SECAF website. That's accessible to SECAF members only. If you're not a member of SECAF, please consider joining. Visit the website at www.secaf.org for more information about membership. Thank you, everyone, and have a good day.